Welcome back to Talk Tickers. If you are new here, this is the show where we strip away the noise, we ignore the clickbait headlines, and we get straight into the machinery of the market. I'm your host, and today we are executing a high-speed, high-definition teardown of the Airbnb Q4 2025 earnings call.
It's good to be here. And honestly, if you follow the travel sector, or really just consumer tech in general, this was the call you were waiting for. This wasn't just a quarterly update. This was a thesis check.
Absolutely. We are talking about ticker ABNB. And right off the bat, we have to address the price action because it really sets the stage for everything we're about to discuss. We're recording this just after the close on February 12th, 2026. The stock closed the regular session around, what, $116?
Yeah, right around there. And it had been just beaten down. It was trailing the SPY, trailing the whole consumer discretionary sector. Sentiment was, let's be polite, muddy.
Muddy is a very generous way to put it. I mean, the stock was down about 15% year to date heading into this print.
Exactly. The market was basically pricing in a slowdown. They were worried about the consumer cracking. They were worried about all the regulatory headwinds you hear about in places like New York. They were nervous.
And then the numbers dropped.
And boom, immediately in after-hours trading, we see this pop 5-6% to the upside. We're seeing it trade near $122, $123.
Yeah.
And here's the kicker, and this is why we do this show. If you just looked at the bottom line EPS number, you would have shorted this stock immediately.
Oh, 100%. And you would have been absolutely crushed.
So let's unpack this contradiction right away. The headline number, the GAAP EPS, came in at 56 cents.
56 cents. And the street consensus was sitting at 66 cents.
That's a huge miss.
Yeah.
We're talking a 15% miss on the bottom line.
Oh.
In a normal environment, you miss earnings by 15%, you get taken out behind the woodshed, the stock should be down 10%. But here, it rallies. Why? Because the market, for once, actually read the footnotes. That miss wasn't operational. It wasn't because expenses blew out or, margins collapsed. It was almost entirely driven by a one-time non-cash tax item.
A tax item.
Yes, specifically around $90 million related to tax provisions. It's accounting noise. So if you strip out that tax noise, the actual operational engine of the business was humming louder than it has in 2 years.
So the market looked past the accounting and saw the growth. Let's talk about that growth because that's the real story. Revenue came in at $2.78 billion.
Which was a beat, up 12% year over year, beating the consensus of about 2.71 million. So, a solid beat.
A solid beat, but the number that really got people excited, the number that I think caused that after-hours repricing was a gross booking value, or GBV.
This is the critical metric.
Yeah.
This is the one to watch because revenue can be, massaged by take rates and different fee structures. GBV is the raw demand. It's the total value of everything, every night, every experience booked on the platform.
And what was that number?
GBV hit $20.4 billion. That's up 16% year over year.
16%.
16%. That is the highest growth rate for Airbnb in over 2 years. And that is what tells you this whole reacceleration narrative that Brian Chesky has been trying to sell. It isn't just smoke and mirrors.
That's what just top.
It's actually showing up in the credit card transactions.
Yeah.
People are spending more often.
And just to round it out, nights and experiences booked were up 10% to 121.9 million. So we have volume growth, we have value growth, and we have a management team that is sounding incredibly confident.
That's the overview. The sentiment flipped from neutral to bearish to neutral to bullish, but very, very bullish on that top line. The big question, the mission of this deep dive is to figure out, is this a mature utility company trying to squeeze blood from a stone? Is the growth over? Or is this actually a company that has reinvented its innovation engine?
Because Chesky is using some pretty big words. He's talking about Project Hawaii and comparing their evolution to Amazon moving beyond books.
It's a huge claim.
I love that comparison, and we are going to tear that apart later in the show. But first, let's just finish the snapshot on the financials because we need to understand the fuel in the tank. We mentioned the TAS issue on net income, which was $341 million, a 12% margin. But what about the cash flow? What does that look like?
The cash flow is a fortress. It's just a cash-generating machine. Adjusted EBITDA was $786 million. That is a 28% margin.
28%. Wow.
And free cash flow was $521 million. So a 19% margin there. And look at what they are doing with that cash. They aren't just sitting on it, letting it pile up in a bank account.
They're putting it to work.
They're putting it to work. They repurchased $1.1 billion of stock in Q4 alone.
1.1 billion in one quarter.
In one quarter. For the full year of 2025, they bought back $3.8 billion. They've reduced the fully diluted share count by about 9% since they started this buyback program back in 2022.
That is a significant return of capital to shareholders. It tells you management believes their own stock is cheap. It's a huge vote of confidence.
It is. So, the financial foundation is rock solid, which lets them pivot to the story. And the narrative here is all about speed.
Right. Brian Chesky, the CEO, he opened the call with this analogy about a cruise ship versus a speedboat. He basically said, look, changing a company the size is like turning a cruise ship. You turn the wheel, and for a while...
Nothing happens. You don't feel the turn right
Exactly. You don't feel it. But eventually, the ship starts to turn.
It's a classic CEO defense for a lag in performance. We're a big company, things take time. But in this case, the data actually seems to support him. He talked about how leading up to the IPO, they were building a 2-story house, but trying to add 10 floors to it. The foundation was cracking.
Right. I remember that period. The narrative was all about fixing customer service, making the app more reliable, just fixing the basic bugs.
For the last 2 years, that's all we heard. Fixing the foundation.
Which is necessary, but it's boring. Investors don't pay a 30 times multiple for fixing bugs.
Exactly. But Chesky says that phase is over. He said, and I'm quoting here, the foundation is now fixed, and they are pivoting to innovation velocity. And this is where we get into this thing they call Project Hawaii.
Project Hawaii. It sounds like a CIA operation or something. What exactly is this?
It's their internal code name for a new way of operating. It's a pretty big structural change. Instead of these massive bloated product teams that take 6 months to do anything, they created these small elite teams, like a little startup within the company.
Okay.
And they gave them a clear mandate. Fix specific friction points in the booking process. Find something that annoys the user and fix it. And this is the key part. Ship the features the moment they are ready.
So no more waiting for a summer release or winter release where they bundle everything together.
Gone. They're moving from a semi-annual release cycle to a continuous deployment cycle. If a feature is ready on a Tuesday, it ships on that Tuesday.
Which sounds more like a modern tech company. And they claim this is what drove that Q4 beat.
They don't just claim it, they actually quantified it, which is rare and, frankly, pretty impressive. They said specific features launched under this Project Hawaii umbrella drove over 200 basis points of night's growth.
2 percentage points of growth just from these new features.
And 300 basis points of GBV growth.
Wow. So that's material. That's the difference between a miss and a beat right there.
It is. It's the whole story.
So what were these features? What actually moves the needle that much?
Okay, so the biggest one by far was something they called Reserve Now, Pay Later.
RNPL. Okay, so buy now, pay later for travel. We see this all over e-commerce. Affirm, Klarna, Afterpay. It seems like a no-brainer to bring it to travel. Why was this such a heavy lifter for them?
It's all psychological. They launched this in the US, and it essentially allows guests to book a stay with $0 up front for eligible bookings. Think about the friction of booking a family vacation 6 months from now.
Right.
You find a great house, it's, $4,000 for the week. Do you really want to drop $2,000 or maybe even the full $4,000 right now in February for a trip you're taking in August?
Absolutely not. That hurts. That's a big cash outlay for something so far in the future.
Right. So you hesitate, you bookmark it,
Yeah.
you tell yourself you'll come back to it. Maybe you do, maybe you don't. Maybe someone else books in the meantime. By removing that upfront clash hit, they saw 2 things happen immediately.
Okay.
First, lead times lengthened.
Yeah.
People felt much more comfortable booking further out in the future. It de-risks the decision.
Makes sense. What's the second thing?
The second thing is where it gets really interesting. The ADR, the average daily rate went up.
Wait. So by letting people pay later, people decided to book more expensive places. That seems counterintuitive.
It does, but it makes perfect sense when you think about it. Specifically, they saw a big shift toward larger homes, 4+ bedroom homes. When you don't feel that $4,000 cash hit immediately, you feel wealthier in that moment.
A wealth effect of deferred payment.
Exactly. You feel like, oh, I can afford this. You upgrade from the condo to the villa with the pool.
Yeah.
You say, you know what? Let's get the bigger place for the family. And that drove the GBV acceleration significantly more than just the volume of bookings.
That is a fascinating insight into consumer psychology. It's not just about affordability in the traditional sense, it's about the perceived affordability at the moment of decision.
That's it. It's a powerful unlock.
Okay, so RNPL was a huge driver. What else did they tweak under this new project?
Two other big ones were cancellation policies and fee simplification. They moved to more flexible cancellation policies across the board, which, again, just reduces the risk for the booker. It makes it easier to click confirm.
Less commitment anxiety.
Right. And then the fee simplification. They started migrating what they call API hosts. These are the professional property managers with hundreds of listings to a single service fee structure.
Okay, let's unpack that fee structure a bit because that sounds technical, but I have a feeling it's really important.
It's super important. Historically, Airbnb has a split fee model. The host pays a little bit, maybe 3%, and the guest pays a huge chunk, sometimes 14 or 15%.
The dreaded service fee at checkout.
The sticker shock. We've all seen it. But these professional hosts, they often cross-list their properties on Booking.com or VRBO. And if the fee structures are all different, the final price the guest sees can vary wildly from site to site.
And they might just book wherever it looks cheapest, even if the base price is the same.
Precisely. So by moving to a simplified fee, where the host absorbs more of the fee but then sets the final all-in price, they can price more competitively against hotels and other platforms. It removes that sticker shock at checkout, where you suddenly see a $200 cleaning fee and a $300 service fee tacked on.
So they're really professionalizing the marketplace. They're making it behave more like a standard e-commerce transaction and less like, a classified ad from the old days.
That is the perfect way to put it. And that professionalization is the bridge to the next major topic, which is the huge strategic pivot they're making regarding hotels.
Okay, this is the part of the call that really caught my ear, because for years, the entire narrative was Airbnb versus hotels. It was a war. Airbnb was the disruptor that was going to kill the hotel industry. But on this call, the tone was completely different. Chesky was talking about opening the aperture.
It's a total reversal of the old dogma. I mean, a complete 180. The old strategy was, we only show hotels when we run out of homes.
A last resort.
Exactly. If you search for a place in Miami during spring break and every single house is booked, fine, here's a hotel. It was a spillover bucket. The new strategy is, we want to be a full-stack travel marketplace.
Full stack. Meaning if I want a treehouse in Costa Rica, I can get a treehouse. But if I want a cool boutique hotel in Soho for a business trip, I can get that too. All in the same app.
Precisely. And they're being very specific about the kind of hotel they're going after. They aren't trying to onboard every Motel 6 or generic Marriott off the highway. They're focused on boutiques and independents. They want hotels that fit the Airbnb vibe.
Unique properties.
Yeah, properties of the character. And they dropped a stat that just blew my mind. They said in New York City alone, they have over 100 hotels with 20,000 rooms on the platform.
20,000 rooms in New York. And that's what, a direct response to the regulatory crackdown there?
It's 100% a direct response. New York City basically banned short-term rentals for individual hosts with Local Law 18. It was a massive blow to Airbnb's core supply in one of their biggest markets. So what do? They couldn't get individual apartments, so they pivoted to the legal available supply, hotels.
It's a hedge. It's an incredible hedge. If a city bans Airbnbs, Airbnb just becomes an OTA, an online travel agency for that city. It makes them so much more resilient.
It is the ultimate hedge. And it changes the frequency of use, which is so important for these consumer apps. If I only use Airbnb for my once-a-year family vacation, that's a low-frequency user.
You open the app once, maybe twice a year.
Right. But if I can use it for my one-night business trip to Chicago or a weekend wedding where I just need a simple room, suddenly I'm opening the app 6 or 7 times a year instead of once. It becomes a habit.
And this leads us to the grand analogy of the call, the Amazon strategy.
Yeah.
Brian Chesky directly compared Airbnb to Amazon. He said Amazon started with books. Books were their wedge into the consumer's wallet. For Airbnb, homes are the wedge.
Right. But Amazon didn't stop at books. Their unifying theory wasn't literature. It was the cardboard box. It was logistics. If it fits in the box, we can sell it and ship it.
And Chesky says Airbnb's unifying theory is the trip, not the house, the entire trip.
It's a powerful vision.
So what else fits in the trip? If the house is just the beginning, what's next?
Everything. Experiences, services, transportation, food. They are actively piloting this right now in different markets.
Yeah.
In Paris, they are pushing experiences, cooking classes, guided tours. In Los Angeles, they are testing services, things like booking a private chef, grocery delivery to your rental, airport pickups.
I have to say, the idea of booking a private chef through the Airbnb app while I'm booking the house is that's compelling. But haven't they tried experiences before? I feel like we've heard about Airbnb experiences for 5 years and it's never really, exploded.
You're right to be skeptical. It has been a slow burn for sure. But here is the data point from the call that suggests it might finally be hitting an inflection point. They revealed that 50% of experiences booked on the platform are now unattached to a home booking.
Wait, explain that. What does unattached mean?
It means people are going to the Airbnb app just to book a cooking class or a walking tour, even if they're staying in a Hilton or even if they already live in that city.
So locals are using it, hotel guests are using it.
Yes. And that proved that experiences can stand alone as a product line.
Yeah.
It's not just an add-on or an upsell for people who booked a house. It's a destination in its own right.
That is a key distinction. That is a really key distinction. Because if they can capture the things to do market, that is a massive TAM expansion. Total addressable market just gets way bigger.
And it feeds right back into that Amazon analogy. Amazon won because of Prime. You go there for everything, it's the default. Airbnb wants to be the operating system for your entire travel life. If they can pull that off, the current valuation is, frankly, a joke. But that is a very, very big if.
It's a huge execution risk, no doubt. But let's talk about where they are finding the people to fill all these trips. International expansion seems like another huge growth lever. They mentioned that 70% of their revenue still comes from just 5 countries.
Which is wild when you think about how global the brand feels. It just shows you how much runway is left. And they're running a specific playbook that they call global scale, local execution.
Okay, give us the examples. Where is this working right now?
Brazil is the star pupil here. They've moved Brazil from being a top 10 market to a top 5 market in a very short time.
Ow!
By localizing the product. They introduced installment payments, which is huge in Brazil. They added local payment methods. They ran marketing campaigns around Carnival. It wasn't just a copy-paste of the American app.
And where else?
India is another one. They saw 50% growth in India in Q4 alone.
50% growth in India is massive. I mean, that is the next great consumer unlock globally.
It's huge. And Japan. Japan is notoriously difficult for foreign tech companies to crack. But they focused on domestic travel, getting Japanese people to travel within Japan using Airbnb, and they said it's really working.
But the strategy that really ties all of this together, both the supply and the demand, is what they call the event playbook. This is fascinating. They are using these mega events as a supply acquisition hack.
This is brilliant. This is maybe the smartest thing they're doing. Look at the Paris Olympics. They added 40,000 new listings in Paris leading up to the games.
40,000.
These are 40,000 people who probably never thought about being hosts before.
Yeah.
But the demand was so high, prices were so high, they looked at their empty apartment and said, you know what? Why not? They listed their place just for the Olympics.
And here's the stickiness of it. The Olympics are over, but those listings are still there. Those hosts are now on the platform.
Exactly. Once you get over that initial hurdle of hosting, setting up the profile, taking the photos, getting your first 5-star review, you are so much more likely to do it again for a regular weekend. It's a permanent step function increase in supply for that city.
It's like a free user acquisition campaign. And looking ahead, 2026 is the year of the event. We have the Winter Olympics in Milan, but the really big one is the FIFA World Cup in North America.
The World Cup is going to be the Super Bowl on steroids times 10. It's not in one city. It's across 16 cities in the U.S., Canada, and Mexico. Millions and millions of travelers descending on these places.
And here is the crucial dynamic. Hotels cannot scale supply quickly. You can't build a new Marriott tower in 6 months just because the World Cup is coming to town. Hotel supply is inelastic.
But Airbnb supply is elastic.
Infinitely elastic, almost.
Precisely. If prices for a hotel room in Dallas spike to $1,000 a night for a semifinal match, people will go stay with their in-laws for the weekend and rent out their house for $3,000. Airbnb can flood the zone with inventory to meet that surge in demand.
And they made a really interesting point about regulation here. Usually cities like New York or Boston, they hate Airbnb. They call it a nuisance. They try to ban it. But when the World Cup comes to town, suddenly the city has a massive problem. Where are we going to put 200,000 fans?
And Airbnb becomes the solution.
Yeah.
It completely changes the political capital. Mayors need Airbnb to make the event a success. They can't do it without them.
It turns the regulatory headwinds into tailwinds, at least temporarily.
It completely flips the script. It turns them from a problem to a partner. It's a 4D chess move.
It really is. Okay, let's shift gears to the buzzword of the decade, AI. Every company mentions it on their earnings call. Is Airbnb actually using it in a meaningful way, or is this just, investor bingo?
It feels substantive here. First, they brought in a new CTO, Amin Ali, who came from Apple and Meta, so, a real heavyweight. And they are deploying AI where it matters most. On the cost side, improving margins.
Customer support.
Customer support is one of their biggest variable costs. They said on the call that 30% of English language support tickets in North America are now resolved entirely by AI agents with no human intervention.
30%. That is a massive number.
It's massive. And they said they're moving to voice-based AI support soon. Think about what that means. You are decoupling your revenue growth from your headcount growth. You can grow the business 20% without having to hire 20% more support staff. That is pure margin expansion potential.
But there is a bear case with AI, right? The disintermediation fear.
Yeah.
The idea that in a few years, I'll just go to ChatGPT and say, plan me a 1-week trip to Italy for my family of 4, and ChatGPT becomes the travel agent, and Airbnb just becomes a dumb supplier in the background.
That is the existential threat for every online marketplace, not just Airbnb. But Chesky had a very strong, and I thought, very convincing defense on this call.
What was it?
He basically said, LLM's large language models are commodities. The model itself, the thing that powers the chat, isn't the moat. Everybody has access to the same models from Google or OpenAI. The moat is the data.
The proprietary data that you feed into the model.
Exactly. Airbnb has 200 million verified IDs. They have 500 million reviews going back over a decade. They have the host messaging graph, which is millions and millions of conversations between guests and hosts. ChatGPT doesn't have any of that.
It doesn't know that the host in Rome is super responsive, or that the charming villa in Tuscany actually smells like cats.
Right. Airbnb knows that. It has that trust layer. You simply cannot simulate 500 million reviews. That's a real defensible asset.
And he also made a good point about the interface, right?
Yeah, that travel is visual. A text-based chat interface is actually terrible for picking a vacation home. You want to scroll through the photos, you want to see the view, you want to look at the floor plan. A chat bot isn't going to replace that visual discovery experience anytime soon.
Okay, so the moat is safe for now. Let's bring this all back to the numbers and talk about the guidance, because this is where the rubber meets the road for investors. The guidance for Q1 2026 was strong.
Very strong. They guided for revenue of $2.59 to $2.63 billion. That represents 14 to 16% growth. The street was expecting something closer to $2.53 billion. So they are guiding for a beat right out of the gate.
And for the full year, 2026.
They're calling for low double-digit growth acceleration. So they're saying the 16% GBV growth we saw in Q4 wasn't a fluke. It's the new baseline.
But, and there is always a but, isn't there? They explicitly stated on the call, do not expect margin expansion in 2026.
And this is what I'm calling the credibility test for management. This is a really important moment. They are generating all these efficiencies with AI in customer support. They're getting tax benefits, but they are telling investors, we are going to spend every single dollar of that efficiency back into marketing and product development.
Why? I mean, why not just let some of that drop to the bottom line and make the shareholders happy with higher earnings?
Because they believe they're in a land grab moment. They see the international opportunity, they see the services opportunity with the trip, and they want to capture it now. If they pull back on marketing spend, they might grow 8% with higher margins. They want to grow 15 to 20%.
That's the Amazon mindset all over again.
Yeah.
Defer profits today for market dominance tomorrow.
100%. But there is a hidden gem for the bottom line that investors really need to know about. The CFO, Ellie Mertz, mentioned something called the One Big Beautiful Bill Act.
The One Big Beautiful Bill Act. I assume that's a nickname for some new arcane legislative tax change.
Yes. It's a piece of tax reform that is going to drop their effective tax rate from around 20% where it is now down to the mid to high teens. And that starts in 2026.
That is pure tax alpha. That's free money.
It is free money for the bottom line. It's a tailwind that has nothing to do with selling more rooms or experiences. It's just math. And it kicks in at the exact same time the World Cup revenue is going to be surging through the top line.
Okay, so let's set the scene for the investor context here. We have a bifurcated consumer, right? Premium travel is holding up, budget travel is getting trickier. Airbnb is shifting to its guest favorites category and higher end homes to capture that premium dollar.
Right.
The stock has been beaten down, it was a laggard, but this earnings call seems to have completely reset the narrative.
It has forced a repricing of the growth multiple. The market was pricing Airbnb like a mature, slow-growth utility company. This call forced them to start pricing it like a growth company again. The beat and raise on the top line proves that the investments they made in 2024 and 2025 are actually yielding fruit. It validates the management team's entire strategy.
So we have a company aggressively leaning into these mega events, intentionally suppressing its own margins to grab market share, all while a massive tax cut is coming down the pipe. That sounds like a powder keg.
It is a very, very interesting setup for the year ahead.
And you know what that means. It is time for our favorite segment of the show.
Oh boy. Here we go.
It is time for This is Not Financial Advice.
Disclaimer. We are not financial advisors. This is for entertainment and informational purposes only. Do not trade based on what two guys on a podcast say. You will most likely lose all of your money.
Okay, lay it on me. We are in the investment committee of a ruthless multi-billion-dollar hedge fund. What is the trade?
Okay, I'm calling this one the FIFA-flated supply squeeze.
The FIFA-flated supply squeeze. I like the name. Break it down.
Here is the thesis. The World Cup in the summer of 2026 is being systemically underestimated by Wall Street. The current models are treating it like a normal seasonal bump, a good summer. It is not. It is a logistical anomaly. You have 16 cities across North America being flooded with millions of people.
And hotels are capped.
Hotels are capped. They literally cannot add capacity. They have a fixed number of rooms. Airbnb is going to be the only release valve for that incredible demand pressure.
So you think revenue is just going to blow out in Q2 and Q3 of 2026?
Revenue will blow out. ADRs will go through the roof. But here's the kicker, the part the street is missing. They're all worried about margins today. They're modeling flat margins for 2026 because that's what management said. But in Q3 2026, you have the one big, beautiful bill tax cut hitting the bottom line at the exact same moment that the World Cup pricing power hits the top line.
A double compounding effect.
It's a double compounding effect on EPS that I don't think is in the numbers yet. The consensus estimates for Q3 26 are way too low. So the trade is this. You go long Airbnb via LAPIS.
Long-term equity anticipation securities, basically long-dated call options.
Exactly. You want call options expiring after the summer of 2026. Give yourself time for the event to happen and for the earnings to be reported. You want the January 2027 expiration or later.
Okay, so long Airbnb calls. What's the other side of the trade? What's the hedge?
You pair it with a short on a generic hotel REIT ETF. Something like a V&Q or an IYR, but ideally one more focused on hotels if you can find it.
Ooh, that's spicy. Why?
Because the hotels are going to be full, yes, but they have fixed costs and they don't have that infinite supply elasticity that Airbnb has. They can't capture the upside in the same way. Plus, if there's a general consumer recession, what gets cut first? Business travel, which is the bread and butter for many of these hotel chains.
While leisure travel to a bucket list event like the World Cup is probably the last thing to get cut from a family's budget.
Exactly. So you are long the flexible, event-driven, asset-light platform, and you are short the fixed asset, business travel-dependent incumbents.
You play the divergence, the FIFA-flated supply squeeze.
That's the trade.
I love it. It's outrageous, it's speculative, and it makes perfect logical sense based on the call. Again, for the love of God, do not do this.
Please don't. We are just talking here.
So bringing it all home for our listeners, what is the final takeaway? What's the one thing they should remember from this deep dive?
The takeaway is this. Airbnb is trying to prove it is not just a travel agent anymore. They are trying to prove they are the operating system for the entire trip. The Q4 results, that GBV acceleration, the successful product launches from Project Hawaii, they suggest that their Amazon of travel pitch might not be as crazy as it sounds.
The cruise ship has finally turned, the innovation velocity is up, and 2026 looks like it's going to be a wild ride for this company.
It's going to be a very interesting year to watch.
That is a wrap for this deep dive on Airbnb. Thank you for listening to Talk Tickers. If you learned something, share it with a friend. If you hated it, tell us why. Until next time, keep watching the tickers.
See you next time.